G'day guys, welcome back to the Devon Too Good Investing channel. Today in this video we're going to be looking into Alibaba stock and we're going to make a decision on whether it is time to sell based on the facts and based on some probabilities of certain outcomes happening. So before we get into this video, make sure you subscribe to my channel and make sure you like this video. And also anything in this video should not be taken as financial advice, and if you need financial advice, go seek a financial professional. So over the last year, Alibaba has been going, it's been really rough for Alibaba. So as of a couple of days ago, Alibaba was trading at, just above $110 per share. And that represents almost a 60% decrease over the past year. And I believe Alibaba at its highs was getting really close to about $300 a share. So yeah, it's been really nasty, and we can see that over the last sort of month the selling has intensified, mainly due to heightened risk of delisting, seeing that Didi, another Chinese company, the Chinese government is pretty much asking them to delist, or well, not asking them, forcing them to delist. Now, if we jump over to the business overview, I think a really important concept to consider is the difference between value, which is what you get, versus price, which is what you pay. And currently what we pay, which is the market cap, is $304 billion. Now, what we get is very interesting. So what we get is, we got net cash. This can be found on the balance sheet. So they got $71 billion in cash, and they got $24 billion debt, which leaves us with net cash of $47 billion. So then if we minus the market cap from this net cash, we can get an enterprise value. And currently the enterprise value based on these figures is $257 billion. Now, each year we're also going to get some sort of free cash flow. So Alibaba is a profitable business and they're going to be producing cash from their operations pretty much. So in 2021, their free cash flow was $26.8 billion US dollars. So if we take the enterprise value of 257 and divide that by 2021's free cash flow, that gives us a ratio of 9.6. And this is on a business that I think will grow between 15% and 20% per year. And historically, Alibaba's grown a lot faster than that. It's been a business that's grown 30% plus per year. However, this year they are expecting a bit of a slowdown, but they're still expecting revenue growth of 23% this year. So it's by no means slow growth. This is still very solid growth, especially considering we're paying a EV to free cash flow ratio of 9.6. Like, usually this, for a business like Alibaba with the quality of the business, you could probably expect to usually pay at least 20, if not 30. If this was an American business, it would be trading at enterprise value of free cash flow of at least 30, if not 40 or 50, up sort of where a business like Amazon or Google would trade. So if we look at the business itself, they've got a 1 billion person user base, and this user base should still expand going into the future. You got to remember, they've got a much larger population than sort of the Western world, especially if you focus down on sort of the US. And Alibaba are expanding into other parts of Asia, such as like Malaysia, Vietnam, and all these like really fast growing places, and they've got large populations there. They've got an extremely dominant moat in the e-commerce sort of section of their business, which does make up a large majority. I believe it's about roughly 85% of their revenue. And then also you got to factor in they've got the cloud business, and this cloud business should grow 30% per year going out, very far into the future. And the way the cloud sort of markets played out in the US is very concentrated. You've got only a few sort of main players. You got AWS, which is Amazon's products, which is by far the largest. And then you've also got Microsoft Azure, which is Microsoft's cloud product. And then you got these smaller players like Google and I don't even know who the fourth one is. Like, it's really a concentrated market. And if this plays out in the same way in, China or around sort of the Asian region, we might see that sort of, having a few concentrated market leaders, sort of where Alibaba could be the leader in sort of China. So I think there's big potential there. It's not guaranteed to turn out in China like it did in the US, but I think there's a fairly good possibility that it does. And currently, the cloud business of Alibaba represents about 10% of its revenue. So not only do we have this net cash of 47 billion, not only do we have free cash flow last year was 26.8 billion, not only do we have an EV to free cash flow ratio of 9.6, and the business itself is very strong. Alibaba also have a 1/3 stake in a company called Ant Group or Ant Financial, and think of it as like a cross between PayPal and Visa, except it's all on an app. It's pretty much a financial super app that a billion people use. Like, pretty much all of China use Ant Group for payments. And this was meant to IPO last year, and analysts were predicting that it was worth about $300 billion. Now, given the facts that they've had troubles, getting the IPO approved, the Chinese government have sort of cracked down on Ant Group, sort of regarding sort of private information that they don't want out there. I think it's reasonable to say that Ant Group is probably worth about 100 billion right now. So if Alibaba owned 33% of that $100 billion stake, that means their stake would be worth 33 billion. So if you add that 33 billion and, sort of minus it away and factor it into your valuation, it makes Alibaba even more cheap. Pretty much. And not only that, there's very heavy super investor interest, and super investors are great to sort of gauge an idea on what some of the best investors in the world are buying. And for me, I don't think it's a good idea to straight out copy them, because I find that I need to have my own conviction in a stock to feel comfortable owning it. However, I do use it as a guide and use it for research ideas, stock ideas that I'll then go take further, and I'll watch the conference calls and I'll read the annual reports and I'll do all my own work, but I'll use it as a source of ideas. And we've got great investors buying in. Obviously, Charlie Munger, he bought more over the last quarter. He almost doubled down in his position. We got Greg Alexander of Conifer Management, and he's an excellent investor that Warren Buffett, highly regards. He owns a stake in Alibaba now. We got Guy Spear, another really great investor who owns a stake in Alibaba. And there's plenty more. And obviously, I do have to point out that Monesh Pabrai did sell, but I expect it's not so much because he thinks Alibaba is a bad business. I think it's more so that he's found better opportunities, and I've got a feeling he might be buying Tencent. But regardless, massive heavy investor interest. And you can see right here, this is so 304 billion is what you're paying, and what you're getting is $47 billion net cash, 2021 free cash flow of 26.8 billion, which should continue to increase out in the future. You're getting a business that should grow 15 to 20% per year. And you're getting a 1/3 stake in Ant Financial, which I think conservatively is worth 33 billion. So obviously, we've gone over what we're looking to pay and what we're getting, but we also have to consider what we're getting as well in terms of risks. And what I've done is I've identified some of the main risks I believe with owning Alibaba stock, and I've split them out into two categories, one being catastrophic risks and one being minor risks. So catastrophic risks for me would be reasons that I would sell it. So this would be me sort of saying, hey, I think the line's been crossed and where I'm comfortable owning it. So I think now I might just have to cut my losses and run. Now, minor risks, these are things that I think, won't be catastrophic to the business, but it's nonetheless, it's still risks and you should still consider them. However, for me, if these minor risks kind of played out, I wouldn't be overly worried. So let's go over the catastrophic risks first. So the first one of those risks is China invalidating the VIE structure. So pretty much because Alibaba is trading, as an ADR, it falls under what's called the VIE structure. And this is it's pretty much a contract saying that you own a shell company. So it's all confusing stuff, but the main thing you need to know is if China end up invalidating VIE structure, this means that you'll probably lose 100% of your investment. So the sort of outcome, if this happens, it would be pretty damn bad. Everyone would lose their money. However, you got to look at the likelihood, and in my opinion, it's less than a 5% chance of happening. Mainly because if China invalidated the VIE structure, that would pretty much limit any foreign investment into their country. So, the way I kind of think about it is, if I was a Chinese regulator, I'd want to do what's best for the country. And in my opinion, limiting foreign investment into the country would be a huge step back for China. This would hurt their growth. This would hurt their ability to sort of, get investment money to grow their own businesses. So it really doesn't make sense for them to do this. While, who knows what could happen, it's still a risk. And then the second sort of catastrophic risk would be the donations to common prosperity. If they became out of control, it would be a problem to me. So this means that shareholders will get very little of the profits, because pretty much any money that Alibaba makes, it would be just then donated to, the CCP's common prosperity sort of initiative. And I think this is probably more likely than the VIE structure to be invalidated. I give it about sort of a 10% chance, in my opinion. This I think is quite unlikely to happen, because it doesn't make sense for China to sort of kill, as what Manesh Prabrai would say, one of their golden gooses. Alibaba is pretty essential to the Chinese economy and the Chinese way of life. It makes up, I think it's a few percent of their GDP comes from Alibaba alone. So, if the government decided to take all of Alibaba's profits and donate it to common prosperity, this would hurt Alibaba. It would limit their ability to grow, limit their ability to reinvest. So I think this is fairly low, and about a 10% chance. And also, there could be unforeseen sort of regulations that come into play that ends up affecting their free cash flow. And I also give this about a 10% chance of happening. So pretty much this is something that we just, something new that could come out in the future that we just don't know about, that, the Chinese government may enact. And yeah, I can't really speak much further about this because, we've got to consider things that don't exist yet because, I plan on holding this for many years. So anyway, on to minor risks. To me, delisting from the New York Stock Exchange is a minor risk. If this does happen, Barber shares will trade OTC, or you can just buy them on, the Hong Kong exchange. Nothing in the business changes when a delisting happens. Like, Alibaba's still gonna make its money. It's still gonna have a great balance sheet. It's still gonna have a moat. It's still gonna have an effective management team. But if it does delist, the market's going to get really scared, and I could probably see a 20 to 30% further sell-off. And in my opinion, I'm not going to sell my shares personally if it delists from New York Stock Exchange. For me, I'll probably just swap it over to the Hong Kong Stock Exchange. And some people say, it's not going to have much liquidity, but look, the Hong Kong exchange is one of the largest exchanges in the world, and it's got some huge businesses on there which don't have liquidity problems, and Alibaba is no different. So for me, the liquidity side of things is not really a problem for me. Maybe, who knows about OTC? I doubt it will have much liquidity problems, but look, I'm pretty confident about having it on the Hong Kong Stock Exchange. And yeah, I think this is about a 50-50 chance. Flip a coin for me, whether it delists. But then again, like I said, if it happens, it happens. But I don't really care. I'll just see it as probably a better opportunity to buy more shares, in all honesty. Other minor risks, competition. So we can see that competition already is coming into play. They're seeing competition from JD.com. They're seeing competition in some aspects of their business, particularly cloud, from Tencent. And also Ant Group is getting into competition with Tencent's WePay. I'm pretty sure it's called WePay. And also some of their international markets are also got some competition, such as I believe the company is C Limited, and that's in competition with the Lazada e-commerce platform out in Southeast Asia. But to me, I do believe that Alibaba's margins will decrease and its growth will slow, and that's been a trend that's been happening for a while now. So competition, in terms of it sort of happening, there's a 99% chance. I pretty much think it's certain. But yeah, you got to factor in competition, and I mean, based off where Alibaba's trading, sort of the multiple it's trading at, I think this is more than well priced in. So minor risks, further donations. So these donations, so I've got donations in the catastrophic risks, and this is if it becomes out of control. But the minor risk scenario is they've got more donations, but it's not deal breaking. It might be donations similar size to what they're doing now. And I give this about a 70% chance of happening. I do think this China prosperity thing will probably be something that stays with sort of these big Chinese companies, at least for, going well out into the future. When the current donation sort of scheme ends, I do imagine there will be a new one. And I suppose it's just a matter of how much is the CCP asking for. So if it's anything similar to what it is now, or a similar percentage of their free cash flow as is what it is now, I feel like it's already priced into the stock. So I'm fine with that. And then no Ant Group IPO. I pretty much put this one as a coin flip. Yeah, honestly, who knows if it's gonna IPO or not? But either way, Alibaba will still own 1/3 of Ant Group, whether it IPOs or doesn't IPO. It just means if it IPOs, they can dump some of their shares if they choose to. So in the end, it probably doesn't really matter. And yeah, these are some of the risks. And then if we move on to sort of what am I thinking? So if things go wrong, which is one of these catastrophic risks that I've got, one of these three risks, I think there's a 5% chance I lose all my money. And then if one of those like catastrophic risks happen, I also think there's a 10% chance that I lose 50% or more of my investment. And currently I am down a fair bit on my Alibaba investment. I've been buying a little bit more lately to bring my average costs down. But yeah, that's sort of where I see it in terms of losing money. And then if things go right, which means none of those 3 points that I had under catastrophic play out and only the minor risks play out, I believe one of these cases will, occur where we either get a bear case, a base case, or a bull case. So I ran these numbers through my discounted cash flow calculator. If Alibaba achieved 12% growth, which I think is extremely low for Alibaba, and have a 2026 PE of just 12, this represents an upside of 23% per year based on a share price of $111. And then the base case, 16% growth, PE in 2026 of 16. This gives us a 31% annual CAGR. And then in the bull case, this is 20% growth, PE of 20 in 2026. And this returns us a 42% annual CAGR. So I see Alibaba as a very unique, asymmetric opportunity where, yes, there's a fair chance that you lose. There's a 5% chance, in my opinion, you lose all your money. 10% chance that you lose 50% or more of your investment. But then I believe there's a 85% chance that you make between a 23% annual return and a 42% annual return. Now, I'm not sure which one of these cases will play out, but this is an asymmetric opportunity where, there's downside, and the downside is very serious. But if things go right, there's you can lose X, but you might make 2X, you might make 3X, you might make 4X, you might make 5X on your investment. So that's kind of where I'm at with Alibaba. For me, this is not financial advice, and none of this video should be taken as financial advice. But I'm happy to hold right now. None of those catastrophic events have played out. I'm fine with minor risks that I've laid out if they occur. And if it continues to fall, I'll probably add to my position. I've already added some. But as of right now, I'm happy to keep holding Alibaba, and I don't intend on selling or buy, I don't intend on selling, and if it falls, I might buy more. Anyway, guys, that's it for this video. Hope you enjoyed it. Like and subscribe, and see you later.